10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
I'm delighted to welcome you to 10lessons.net. The lesson today we're discussing in Lesson 8 is having a trading plan. It's essential that you do. This is a very key point. Before I go on, I just want to go over the disclaimer. Before using this video or any of our books or newsletters, all the information and videos are educational purposes only. We don't offer any financial advice. Do your own research. Today's lesson on number 8 is having a trading plan. It is essential. If you were to start a new business today, you would not start a new business without a business plan. You've got to know where you're going, what your strategy is, what you're going to do, how you're going to do it. What's a risk? This is really, really important. You can't just go in there and not know it. And also when to compound. This is really, really important, because if you compound too soon, you could lose. We don't want that. So your trading plan should be made up of all these elements. Okay. So on the left we have the overall financial goals. What do you want to achieve month by month, year by year? My target, and it's often reached, or even more actually, is I want to reach 20% per month. Last month we made 21%, so that's good. And this month we're on track to make more than that. So this means that I will double my account every 5 to 6 months. So I can plan ahead for the year, for 3 years, for 5 years, very easily based upon that. Understand how the market works, where to get an edge. Everybody wants to trade the market, everyone wants to learn. But you must have a strategy which is different, and ours is completely different. Acceptance of risk. We understand there is a risk, but understand we want to minimize that risk. Expectancy is a real key here, because if you expect too much too soon, you will be disappointed. Developing multiple systems. Well, we use 3, don't we? If you've done the 10-day module course, you understand that we have 3 systems. We trade trends, where the price is moving in one direction, and we trade swings, and then we trade divergence. Trading like a business is exactly that. It's exactly that. Don't count the pips, count the percentage returns over a month. Not today, not tomorrow, but over a month. And so on. So this goes on. Planning your trading month. Know what you want to expect. Tactical systems, individual system objectives. You should know that. Defining the market type. Again, that goes with correlation, doesn't it? Finding a low risk setup. We always do that. Stalking entry. Don't like that word, but that's what we're doing. Setting your risk, trade management, scaling, exiting the trade, an important one, re-entry rules. So we cover all these. What to trade, how much to trade, and so on and so forth. It goes on. Make sure you're clear about what you want to do. So in money management terms, this is quite a simple way of doing it. And it's one thing that I've always done. If you're starting with $10,000, let's say, and you risk 2%, and your position will be risking $200. Fair enough. Low risk strategy, that's what we want. With an expectation to make 600 to 800 on each position. That's asymmetric gains. So if you risk £100, you want to make 300, 400, etc. In order to compound, at the beginning of a new month, let's say your account is now worth 12,000, reasonable return, you've had 20% growth, then you still risk 2%. But now that something's changed, hasn't it? So now your risk becomes £240. This compounds your account exponentially and in a very safe way. Sometimes I may add to positions to compound, but that's rare. This is a far better, safer, long-term method of building your business. Managing risks, again, we discussed this in all the webinars with members, and it's really important to understand risk by using stocks. You have to use stocks in this kind of market. With the shares, that's different. We don't use stocks for shares. We just buy the asset. So in this instance here, you've seen this chart before. This is a swing low on the pound USD. It was in an uptrend. We've used the Fibonacci retracement to come down to 50%. Now the temptation here is to put your stop at just below the 50%. It's a little bit dangerous and a little bit risky. We would recommend you have a much wider stop at below 61.8%, because that keeps you in the trade longer. And if the price does breach the 50%, it's likely that it will probably go back up later on. Now hindsight's wonderful. In this instance here, you could have had a stop just below the 50%, but quite often we see prices break the 50% but then bounce straight back out. So thanks for attending lesson 8. Hopefully that's brief, but have a plan, have a trading plan, have goals, and have objectives to aim for the month, for the year, for 3 years, and have a trading plan that works with low risk entry. Thanks for attending lesson 8, and I look forward to seeing you in lesson 9.